Tuesday, June 20th, market analysis, Stan Ehrlich. And yesterday was a significant holiday, Juneteenth, so we didn't have any markets to speak of, a little bit, but there was no recording and no market letter. So I start out with stock market indexes, and usually with the S&P 500, which is exactly what I'm going to do again this morning. We have a gap down market. I've been telling you for the last few days, trading days, that the market is overbought and deserves a correction. On Friday, we started to see it have the correction, dropped a few points, nothing dramatic. And this morning it opens a little bit lower, creating a down gap, and drops off about 4 points lower at the low, and has come all the way back up at the moment. Let's look at the 1 minute chart real quick. For today, it's come back all the way to where it opened, and the gap is not closed yet. Now, remember, gaps are almost always closed, and I do expect that this gap will be closed, not necessarily today, but sometime in the near future after, and it may be closed today and then go down and close some gaps, or first go down, leaving this gap behind for the moment to close some gaps. Now, those gaps in the S&P 500 are around 423. We're currently 37 3/4, 437 3/4. So we're looking at approximately 24, 25 points lower, 15 points lower, not a heck of a lot. That could easily happen this week, and frankly, I expect it to happen this week. It might take another day or two more, but pretty quickly, maybe even in a shorter time period than by Friday, like a couple of days. There's also the same kind of thing happening in the DIA, the Dow Jones ETF. We have a down gap, and the difference on the DIA than the spider is, I've been talking about this head and shoulder, or theoretical head and shoulder bottom, that appears to have formed starting with the shoulder lows back in December, the bottom, the head, March 15th, 50, that's right, and the last shoulder, end of May. Now, if that's all true, firstly, the formation is forming about where it shouldn't. Usually head and shoulder bottoms are just that, bottoms. They're bottom of a bear move, a bear market, an extended bearish movement, not necessarily a bear market, but something that's been going down for a little while. This head and shoulder bottom is a significantly good size, 6 months or so. And that would normally be after, I would say, 3, 4, 5, 6, 7 months of decline. Instead, it seems to have formed, and I'm going to tear it apart in a minute, on the way up after a major bottom, which was October 13th, for all of the stock market indexes and much, much, much more. So the bull market began October 13th. We stalled out in the DIA and the early part of December, and then had a modest correction. That's what it looked like at first. A rally that couldn't and didn't make new highs for the trend, and then dropped down one more time into March 15th. And then again had significant problems at around 342, 343 area, and had one more correction, which again was just last month, the end of May. So we have now rallied into new high ground since December. And that breaks a line you could have drawn, or should draw, across all of these tops, except for the November rally part. That's the neckline, if you think this is a head and shoulder bottom. The problem we've got today is, after the market last week pushed through the neckline a little, dropped back on Wednesday, Thursday and Friday got above, stayed above, and closed above the neckline, even though Friday was a little bit of a down day. Today we are below and staying at the moment below the neckline, which is this large fat dashed line I just put little white dots on. That line is the neckline. You're not supposed to go below the neckline. That's one of the golden rules on head and shoulder patterns. Once the neckline's crossed, it's supposed to stay on the other side of it. This is dropped back below it. That's usually not a good sign for head and shoulders. So not only is it potentially formed on the way up in a bull trend, which is not the right place for it, but it's also violating the rule for the neckline. So we're going to see as time passes, obviously, how this pans out. But right now, it's significantly iffy that it's really the classic head and shoulder. But I'm going to leave my little markings there in the neckline, the objective, and all that for the moment, and see if today we climb all the way back up and close the gap and stay there, or even rally more. Then you could have claimed that drop below the neckline for part of one day and pop right back up again like a ping pong ball being pushed underwater and let go. And the concept of the head and shoulders is still good. But if it stays down here and or goes down a little bit more in the next day or two, and it's got that gap to close, the DIA, like the S&P, like the QQQ, like the Russell, all four of them have gaps to close from approximately 2 to 3 weeks ago. And so around 332, there's that gap to close. That is what I'm looking for. This gap to close, and the gap occurred between Thursday and Friday, June 1st and June 2nd. So a little bearish for the moment on stock market indexes, looking for gaps we left behind a couple of weeks ago to get closed and then back up again. I am not changing my bullish expectations at all. It's just a matter of figuring out how low can it go before it starts to head north again. The QQQ, same situation basically, came up to almost exactly highs that were made way back in March 29th of 22, 14 months ago, and stalled out in overbought conditions. And I didn't mention that all of the indexes have been overbought or were overbought on Friday, Thursday, and Friday. So it's not surprising that for that simple reason, we're having a correction. The second reason is the gaps to close below the market. So for the QQQ, we're looking at a dip down to about 333 and a tiny bit higher, right around 333 to close the gap. And we're currently at 366, 367. So that is something I'll be watching for very carefully. And I am predicting that that is going to be the case. I hope, I expect that the gap's going to be closed at 333 and then back up again to new high ground completely. Now, in the interim, on the way down, because this is a bull market, a bull trend, and I expect it to perpetuate itself, I've got to try to figure out whether the gap is going to actually end up being closed. It might come close. It may come down halfway. It may make an effort to do it and not quite finish the job. The Russell 2000, I have to comment about because it's acting just dead perfectly. We have a bearish engulfing ER sell signal last Wednesday. It is the high of the rally. It was overbought and it was in a resistance area. Great reasons to expect it to pull back, which started basically on Friday with the other indexes and almost had another bearish engulfing, not quite, but today has new lows for about a week and a half. Now, at the moment, everybody's right back up near their high of the day, trying to see if they can close the gap from this morning. There's no gap in the Qs or the Russell, just the spider and the DIA. Yeah, there was a little gap earlier in this QQQ, but it closed it right away, first thing in the morning. So now the gap to close below the market in the Russell 2000 is at 176. And about the same distance, relatively speaking, for all of the indexes below the market. So it all kind of makes sense. you've got the overbought conditions, you've got gap to close at lower, and then other reasons in the case of individual symbols that the market would stop where it did, like this Russell resistance area, and the Qs having reached a high of 14 months earlier, etc. Enough about the stock market indexes. Let's go look at the futures markets. And we've got another brand new signal today, but I always start out with a spider, E-mini, and it's the same as the S&P, except remember they have different trading hours. And that means that you're going to end up with slight variations of formations, but they're usually the same formations. And you might end up with different bearish or bullish engulfing situations. A few more probably on the E-mini because of the larger range potentials being longer trading hours. Nevertheless, we do not, in this case, have a gap to close in the spider for the very reasons I just said, different trading hours. But we are in the area of previous highs, and it's stalled out in overbought conditions. So looking for more of a correction and then a move back up again. Next is interest rate futures. The 30-year long bound is doing a fantastic job of holding a major bull trend line from the lows starting in oversold conditions on October 24th of last year, and across a low only a couple of weeks later, and a low that was made in February, and recently in the last few weeks bouncing basically off that line, definitely on a closing basis, but we have one little violation during the day, and bounce and bounce and bounce and bounce. So I like this trend line very much, and today we have a bullish engulfing. It's not an official ER buy signal because we weren't oversold at the same time or within the allotted number of days before. But I like the way it's acting. It looks like it's about to have a new high for a month or more and start to rally into new high ground for interest rate futures. Now, I've got basically the same commentary to make for the 10-year notes. And I'll change the chart in just a quick second. The 10-year notes did not test their bull trend line. It came pretty close. And they do have a bullish engulfing at the moment, barely, not as visually obvious as the bonds, but it's there. And I like what I see. I think we're going to start pushing up into the trading range in both cases. That was in March, April, May. And if we make new highs for, say, the last several months in both cases, we'll have a major bullish breakout, which is exactly what I expect. It may take a month or two. Next, energies. We're going to start out with the crude oil, which has a bearish engulfing today, a higher high than yesterday, and a lower low than the previous trading range day, which was last Friday, and a current quote that is lower than the previous close. So this implies that we're going to start heading Tierra del Fuego south. And I do expect to see new lows and new low closes happening soon, a few days, maybe a week. I'm basically bearish on energy futures. The next one is heating oil, and we have what appears to be the beginning of the next leg down. Now, we did pop up above a little resistance, but it came almost into overbought condition, just barely missing it by a hair, which is exactly what it did in the beginning of April, and that topped the rally out. So I think we've got the same conditions here. Early April, rolling over at resistance, heading south, and I think we're going to see the same thing happen right here. So I'm now looking for a new low for the trend soon, and it's going to be a whopping major bearish breakout. Next, natural gas. Guess what? We got overbought, and we do have a bearish engulfing ER official sell signal. It looks a little like the top of the rally that started early June. So that's it, I think. As long as it stays with a closing price lower than yesterday's close, lower than Friday's close, then we have an official bearish sell signal. I'd like to be able to sell it short with the red dot, and that price could change by the close if we make new lows within the next few days. But remember, ER1 is always in a position once the price bar changes green or red the moment it happens. So that means it's already happened today. The bar is red. We have an ER sell signal, bearish, period. I'm looking for lower levels. This is supposed to begin the next leg down, and it will be very, very profoundly bearish. Because of the low levels we're at, I don't think it's going to drop like a rock, but the trend should perpetuate itself down. Next, cocoa. And it's been staying below that previous bull trend line now for several days. And this looks like a new low closing price for the move down. And I expect to see a new low and a new low close in the next day or two to perpetuate this bear swing. Now, the long-term trend may very well have changed because our only decent bull trend line is gone. And you could draw a brand new bear trend line across the highest high here in overbought condition, and the lowest, the appropriate recent rally high, which is just on Friday, probably. I think it's a little premature to draw that line in. Doesn't hurt to do it. So looking for lower levels, and the next stopping point would be a minimum downside objective of 1,853-ish. Next chart, silver, just a moment. That was gold, right? Did I say something else? I think I mislabeled it. It's gold, and the next one's silver. And we have a big break, new low close for a couple, 3 weeks, and almost already a new low for the move down. I do have to mention again, this is an incredible combination of signals that my system has picked off. We have in all three metals, the low in either early March or very late February. The bottom, it began a very, very nice rally. In the case of silver, this chart, we ended up with a rally high on April 14th. We caught it with a bearish engulfing ER sell signal. Dropped off a little, came back to try to make a new high for the whole trend. It stopped right at the same prices and had another bearish engulfing, creating the potential, the likelihood, the possibility of a double top, which it did. As it started to slip down, we have a third, as I nickname it, complementary, bearish engulfing ER sell signal. And the next day, kaboom, new lows for weeks. Big sharp break, starting to get a little oversold. Really couldn't shake it off, still kept on going down. The minimum downside objective from the double top I measured turned out to be 22.9 something. We got there and a little bit lower for only a day and a half or so. And guess what? Bullish engulfing at the bottom, ER green buy signal. Nice rally for a couple of weeks. Unfortunately, we didn't get a signal here on June 9th, but it rolled back down again. And I think the trend is now very iffy about being a bull trend. And I'm looking for a minimum, as I've said before, test of 22.7.80. And probably that's going to get broken, and we could very well get all the way back down to 20. Next chart, copper, platinum. Well, platinum. As I said, we caught all three precious metal bottoms. The platinum was on February 27th. We now have a broad double top. The second high is kind of a smaller double top in itself. We caught the top of the first high back on January 11th, just right, and the bottom just right to the day. Now, we had a bullish engulfing 2 days ago, last Thursday, that as of today, it didn't work. That's the kind of thing you see in a bear market. Bullish signals that don't work very well, work very little, or plain old every day don't work. This one worked very little. It only produced a modest rally the next day, and I don't call that particularly anything to write home about. So today we're getting oversold again, and we broke the lows of the signal day on Thursday. So that was a bad signal. It probably offered a very minor profit potential, but that's about it. And more likely than not, anybody that tried to trade it probably lost a little bit. But we always have protective stops in the moment we get in a trade. We are never in a trade without a protective stop, and that's commonly called a stop loss order. I like to call them protective stops. So, bearish, looking for a test of previous lows back in February. That would be around 912 or so, and 913. Let's see what happens. Right now, we're getting a little oversold again, so I'm not expecting a real fast, big breakdown. Maybe a little bit of bouncing back and forth on the way down. Next chart, high-grade copper, got overbought, slipping back down a little this morning. Trend is now down. It's been too many months since we've seen any higher highs. We haven't, and we've seen lower lows. Looking for a test of 3.5 on the way down, and probably even lower after that. And we probably started the move down today. Next, soybeans, very overbought. Now getting toward the extreme overbought. So the odds of it topping out, plus the fact that we're in a resistance area in general, on top of the extreme overbought, really adds up to watching for sell signals very, very closely. And we're already back down in the middle of today's range and have given away at least half of the rally of the day. So today's highs could be it. I can't tell yet. But I would not be surprised if today's high ended up being the high of this rally. On the way down, I think we're going to easily get down to 1390s, 13 low 90s, 1370s, and maybe down to 13 teens, 1310 to 20. That looks very plausible. Pretty good move down, in fact. Next chart, bean oil. Hey, same comments. Resistance areas, overbought. Wouldn't be surprised if Friday, in this case, not today, was the rally high. Today we're having an inside trading range, no higher, no lower than Friday's range. And we are down just slightly on the day at the moment. Let's see how that pans out. Downside objective would be a test of at least 51 area, if not down to about 45, 46. Next, soybean meal. Now we've had a rally on Friday, a little bit more this morning, Tuesday. Remember, yesterday was a holiday mostly, and ready to slip down. I think challenging this little double bottom at 387 and make new lows. Now, there are a variety of support areas below that, but looks like it's going to continue to chew its way down, breaking various support areas on the way down. And I would not be surprised to see it down in maybe a few weeks to 335-ish. Next, corn. Well, we broke the bear trend line decisively on Friday. So are we going to drop back below the previous line again and only have broken it for 1 day and a half? We're overbought. I think that's quite possible. I'm going to have to wait and see here. This is a new high also, but right smack against previous tops. Look at that. Today's high is right up against most of the highs we had in January, February. And that's very interesting. Also overbought. I think it's going to head back down. I don't think that trend line is going to be any good anymore, that bear trend line. It'll either have to be redrawn or just deleted. I'm expecting a move down now to test the $6 area and even lower. Yeah, that's the way it looks. Next, wheat. Bear trend, obviously. Overbought 3 days in a row, including today, up against resistance, and has more major resistance levels, not too much higher. So if there is more strength, I don't think it's going to go further than, say, approximately 744. at best and turn down to new lows for the bear trend. Next, cattle. We've had 2 bear signals in the last couple of weeks. One on top, just like the ER signals are built for. There's a complementary last Thursday. On Friday, we managed to get up to the ER3 sell signal, red dots. Today, we're 100% below the red dots, and it's starting to make more money because the new short on Friday was a small profit, and it looks like we're going to have a new low close, or close to it. It's not guaranteed. And I think we're going to see a new low for the move down in the next day or two, real soon. The sell signals will have worked past tense just great. Next, hogs. We got oversold at the bottom. We started a rally. Today's high is up against a previous high that was made on April 28th, almost exactly, just maybe a couple of ticks higher. And resistance in a general sense from way back in May and June of 2022. So that's it. This, I think, is a rally high. We're still close to the high of the day, but there's a variety of features here, mostly resistance and overbought conditions that imply that it's going to run out of steam and start heading south. It'd be great if all of a sudden it's got below Friday's lows, and if so, that would be a bearish engulfing new red bearish ER sell signal. But I think we're about at the top right here of this rally. Next chart, OJ. Not much to say about OJ. Sideways trading range, slowly bullish. Trend is up. Trend is your friend. So looking for a test of the highs of the rally, 292, 293 area. Next chart. Overbought conditions in late last week, starting to slip on Friday and following through a little bit of a dip more today. Now, there's support underneath this bull trend in cocoa. We might come down to approximately 3,071, beginning a little support, maybe even a little lower than that, possibly down to about 29.88. But the trend is up. I like what I see on a longer term basis. Looking for buy signals after more of a correction. The overbought condition that we did get into is very substantial, way up in the high 80s. And that's classic to cause the market to turn back down. It did follow through a couple more days for a little more strength, but here we are starting to swing down on Friday and following through a little bit more today. So this looks like a correction in a bull trend, mostly watching for buy signals soon at a bit lower levels. Next, cotton. Sorry to say, guys, we have no major breakout up or down. It's just a sideways, slow, neutral market. No comment. Next is sugar to sweet, coming up, getting close to making new highs for the trend, which is obviously up in a very, very strong bull market. But you've got to watch at this point for double top formations. We're up against resistance, which has proven itself to a degree already. Now, we did get oversold on one day after a correction, so it's not surprising that we're bouncing pretty good. You know what this looks like? This looks a little like the silver market when they had its first high, dipped down and came up to a second high, except I'm missing the bearish engulfing red sell signals. But the formation has some similarities. Next chart, we're back to the E-mini. You guys have a great day. I had a great Father's Day. Hope you guys did. See you tomorrow.